Welcome back. You're watching IndianOpen right here on BloombergQuint Live. Asia as a pocket is more mixed bag, but it's coming off, with the rest of the world and what US is doing in terms of creating fresh new highs. While we're not doing what Asia is doing, we're actually positive by about a tenth of a percent or so, which could indicate that we could make our record highs in today's session because we're just 20 points away.
Yeah, the momentum is good, and even if we don't do it on open, it might well be a day like yesterday, a trending day upwards, and let's see if that
you don't need much of a trend to scale 20 points.
That too. Yeah, no, but it'll be nice if we eclipse that and then we stay higher as opposed to coming off. Now, again, I don't know if the political developments have a bearing on the markets today for a very short term or no. Let's wait and watch. It'll all get decided over a period of time today. Maybe we don't do it on open, maybe do it in 10-15 minutes after that. But yeah. 20 points, yeah, we might well have a shot at doing that immediately.
Yeah, and Bank Nifty too, 31,784 highs, so I think that could also, because it's just, I think, 240 points away from there.
Yeah, and they looked strong yesterday, the banks.
Yeah, I mean, most of your banks contributed on the upside, and it's not just the smaller PSU names we're talking, because they sort of lost their luster after the initial pop that we've seen. So a lot of cues to keep in mind. Bank Nifty near record highs, the Nifty 20 points away. Reliance Industries, I think, about 20 odd points away from 10 lakh crores. So just keep an eye on all of these variables. But also keep an eye on what's been happening in the derivative space. While we're extremely excited about reaching those record highs, they're probably coming on the back of shots getting covered and not any excitement on the long side, Navneet, from the FIs.
Well, actually, it's a mixed bag. There was short covering, but we also saw some fresh longs coming about across the board, not only for FIs, but the stage is set. Cues are positive from yesterday's trading action, 30 points away for Nifty. Look at the rollovers. Yesterday, we stood at about 26%, but across the series, the open interest for Nifty futures went up by 6%. Another positive takeaway from yesterday's trade was the premium on both Nifty as well as the Bank Nifty futures expanded vis-a-vis the previous trading session. Pull up Bank Nifty as well. Across the series, open interest went up by only 2%, but the rollover stood at about 29%, and Bank Nifty is also just 230 points away from its all-time high levels that we had seen. Looking at the options data, the put-call ratio yesterday inched higher to levels of 1.7 versus 1.3, and this was on account of aggressive put writing which came into the system. Of course, after yesterday's rally, the base for this market has been moving higher. So for this Thursday's expiry, maximum open interest seems to be at the 12,000 strike for both call as well as put, but you can see the red bar is overtaking the green bar, telling you that there is more of put writing which is in the system. And of course, 11,900 has become a support for this market. What happened yesterday? For the first time after reclaiming the mark of 12,000, the call writers ran for cover. So that was another major takeaway. So unwinding scene for 12,000, 11,900 call strike, while you did see aggressive put writing coming in at the 12,000 mark. The range where the traders are now watching out is 11,900 to 12,200 on the upside. Talking about the stocks then, fresh long positions were seen for Tata Steel, Hindalco. Metal stocks have been in focus of late. Zee will be in focus after Subhash Chandra stepped down as chairman. So short positions were seen yesterday for this one. And while Indigo, which was up 4% yesterday, did witness some bit of short covering. If you look at the FI data, of course, they bought heavily into the cash segment, 900 crore. But look at the index futures. They created more long positions. Almost 12,000 contracts were added. While with that, you did see unwinding of shorts. And that's a major takeaway. Even on the index options side, there were more long positions added via call long as well as put short, while unwinding of short positions were seen here, put long as well as call short. Let's see on the FI front if there is more short covering which comes about or not, but definitely looking at the cues, the stage seems to be set for hitting all-time high levels on Nifty. With that, it's back to you guys.
All right, so on all variables, we're just about sitting on the edge, sitting on the fence, ready to jump over. Mayuresh Joshi, head of equity research at William O'Neill, is joining us right now on the show. Mayuresh, stones throw away from record highs. We've seen cyclicals, play their cards well over the last week or so. Metals as a pocket is spruced up. Autos has started to come back in. Consumption too, the likes of Nestle has really, garnered some attention. What would you do right now, and what's the sense around, fresh investing?
Morning, Devina. No, so clearly I think the market's in a state of euphoria. I think that's what clearly is getting displayed in terms of the levels, both at the index end and even the broader market rally. I think a lot of broader market stocks are still languishing. I think where the numbers have been a little bit better and where the expectations in terms of the earnings landscape probably looks a little bit more brighter over the next few quarters. I think the sector stocks are probably reacting to both these elements accordingly. Having said that, when you're probably expected to see in terms of the cyclical movement, I think banks as a pocket have done exceptionally well. For metals, again, I think the resolutions that one really expects to come from the US-China trade war and the belief that at some point of time, realizations on the LME will start picking up. And as both these factors move in tandem, the expectations of leverage playing on the balance sheet and improvement of cash flows emanate on the bottom lines and the earnings is something that the street is hopeful about. But I think the sector still looks a little bit patchy in terms of a few key variables. So the demand-supply dynamics still look a little bit skewed. What you probably expected to see on the input side, input costs have definitely moderated quite a bit, whether you talk about iron ore costs, whether you talk about petcoke costs, so on and so forth. But genuinely, I think for realizations to improve, I think the demand-supply dynamics need to come back. So I think it's more sentimental in nature at this point of time. Consumption, as you rightly pointed out, I think will again largely depend upon how the Rabi season actually fares. So again, the initial take that we probably have in terms of better reservoir levels, good moisture content, will probably ensure that Rabi output is probably far more resilient this time round, which means that Q4 should probably be far better from a rural discretionary spending perspective, though one has to balance out how the rural inflation is panning out at this point of time. So yes, consumption as a pocket can do well. We do like banks from a cyclicality perspective, but one really has to be very, very choosy, specifically where the index is at this point of time.
Mayuresh, the other bit is that while we are seeing what metal stocks are doing individually, and all of them are hitting those highs, and selectively the steel companies are doing that, the others are not. The question is, if the presumption is that this up move could well continue aided by the global markets, would you rather play steel and the cyclicals, or would you stick to the tried and tested? Given a choice between some of the private sector banks which are moving up versus some of the metal names which are moving up, the large caps, where would you place your money on?
So, morning, Neeraj. Again, I think it's a question on how you're trying to position yourself. If you're probably taking a very myopic or a short-term view, as I said, I think metals probably can give you a better move compared to what the banks have done, because the banks have actually given you a stellar move over the past few months and quarters. But what has probably happened and transpired over the last few weeks, and what is probably expected to happen for the sector as a whole, though I think the non-food credit still languishes around 7.98 odd%, you're still expected to see the private sector guys who have probably delivered better numbers both in terms of advances and the deposit growth as well, continue on this growth trajectory. What this also does in terms of the provisioning that they've actually done on their balance sheets will actually shield them as the write-backs also start happening. Similar is the case with a lot of PSU banks with the SR resolution as well. But I think the private guys are better placed from both these elements. So I think the return ratios will definitely improve as the NIMs and spreads and the asset quality also stabilizes over the next few quarters. For metals, Neeraj, as I said, I think input costs have definitely moderated. What you're probably seeing in terms of a play between ferrous and non-ferrous, I think the HRC, CRC prices are still languishing at low levels. What you've also seen in terms of the overall LME pricing, whether it's steel, lead, copper, zinc, aluminium, I think all these prices are at absolutely low levels. Obviously, with the backdrop of the US-China trade war, but a large element here also comes to how the results have been. So the results have been extremely soft for the quarter gone by, and though I think Q3 might show a little bit of more resilience on the input cost front, I think stocks, for example, like Vedanta, I think they clearly got hammered because of lower aluminium prices, what you probably expected to see in terms of the alumina offtake as well, and the other elements in terms of the overall earnings trajectory. The coal inputs also from its mines probably a little bit short than what one really expected. So again, I think as a short-term tactical play, metals can very well be the flavor, but from a medium-term perspective, I think banks is something that we'll still bank upon.
Right. Mayuresh, stay on with us. Lots more to talk to you about, but there are also many more stocks to keep a track of as we set up for trade this morning. So we've got a research team ready with us to take us through all of that. I think Nikki is going to run us through those stocks and news. And then the pharma space gets into attention with regards to some price fixing issues in the US. Darshan talks about that. So let me start off with you, Nikki, first.
Sure. I'm going to start off with Zee Entertainment Enterprises because that's one stock which is expected to be in focus. Subhash Chandra has resigned from the chairman post with immediate effect. He will remain as a non-executive director of the company. Earlier, Morgan Stanley report said that with the promoter stake already coming down from 42 to 5% over the last 1 year, set of financial investors have already picked up stake and they would be wanting that. For that, these changes might be a requirement from the incoming investors, according to the brokerage. They've also said that SEBI rule has asked the country's top 5 listed companies, 500 listed companies by market capitalization, to split that post of chairman and managing director from April 20. In effect to that, this change also could be one of that, and Zee Entertainment probably is moving ahead of the curve. Thomas Cook, not sure about on the reaction, but then it's definitely a development. Completed its corporate restructuring process and has now demerged its human resources business into Quest Corp. Also, we're looking at some amount F&O exclusion. So Dish TV, NBCC, Tata Motors, DVR, Castrol, these are the stocks which are going to be excluded from the F&O segment, and there's going to be no contract to be made available for trading from Jan 31, 2020. Last on the list, we're looking at Reliance Communication, where the company finally has received resolution plans coming in from Bharti Airtel and 2 other investors for the REIC on November 25th.
Right, Nikki, thanks very much for that. Darshan, what's happening with pharma stocks?
Yeah, so probably some of them could react negatively. Now, Bloomberg has reported that Teva, as well as other generic pharmaceutical companies, have started, talks with the U.S. Department of Justice in terms of the long-pending investigation of price rigging that has happened in some of the drugs. Now, what has been happened is that the possible outcome for this entire thing could be deferred investigations, deferred prosecution agreements, as well as fines. Now, the other thing is Sun Pharma also is in talks separately with the US authorities in terms of price issues with its subsidiary Taro. Now, there are 2 notes that have come out. One of them is from Credit Suisse, and they are saying that the price fixing probe is an overhang for Sun Pharma stock, as the market was not factoring any kind of potential penalties that will come in, and if the penalty is significant, it's negative for Sun Pharma. But remember, also companies like Dr. Reddy's, Glenmark, all of them have also been involved in this, so there could be a minor reaction that could come in. Investec says that they expect more announcements to come in on this front, but they're not sure whether it could be on the positive side or the negative side. And settlements are typically generated with each generic maker, which means that the level of penalty will not be the same. It will be dependent on each generic maker. And there are 3 more separate litigations that the generic market makers will have to go apart from the DOJ to get a clean sheet. So it's a long way ahead, and probably some of these stocks could react negatively to this.
All right, we keep an eye out on all of those pharma names. Nikki, Darshan, thanks very much for joining us with all of those news-based stocks. Come to you on Zee, Mayuresh. Now that Subhash Chandra has given up his chair, what's the way forward? I mean, this was something that probably is a result of the stake coming down so drastically to just about 5% odd. But what should one do if they're already invested in Zee versus whether or not they want to take a play on the operational performance going forward and invest right now?
So, I think it's been an obvious move considering the pairing of the shareholding that has probably happened at this point of time. But when you probably look at the 2 elements, I think, one, the operational element in terms of how the numbers have fared and how the entire landscape looks, specifically in the media space, and how Zee is positioned. And the second element, with new investors coming in, what kind of disruptive changes can you expect to see from a management perspective? So on the first element itself, I think the earnings have largely held up. Now, what you're expected to see in terms of ad growth, I think, with the slowdown that we're probably witnessing across sectors, I think there might be some moderation on that front. So largely, I think the street is trying to factor in that maybe a few quarters down the line, I think the normalization on that front will start happening, which replicates in terms of margins normalizing as well, and having a ripple effect in terms of how the bottom line will grow. The second element, obviously, is the management change thereof. And the kind of direction that one can get. But I think there is no hard and fast rule that is probably attached to this. I think being an established player that it is across regional genres that you've probably seen, I think they're trying to establish a good market foothold. And that you've probably seen from their subscriber growth as well. So I think not expecting too many disruptive changes coming through from the management side. I think it's just a perspective in terms of how earnings will stack up over the next few quarters. Might be a tad bit soft, at least for the next quarter or two as far as the ad revenues are concerned. But I think the street will start gestating that in and build that in terms of numbers as they roll on 21, 22 numbers for Zee. So I think the business model per se, I think is robust. I think the positioning that it probably has is quite strong. From a price action perspective, I think as per our methodology, I think there is still a little bit of time to go. So I think let it stabilize, let it consolidate. Maybe I think the next few weeks or months, I think you'll get a better entry point into Zee.
Okay. Now, some more stocks that will be in focus. Remember a few days back, we had done a piece on the MSCI changes and the kind of rebalancing and the impact that will have on flows for specific names. And a lot of stocks would be in focus today. I mean, the large ones like Reliance and some of the others like ICICI Bank, as also mid-sized names like Colgate will all be in focus today. So do watch out. 26th is the day from a lot of these become effective. And mind you, the dedicated funds would essentially put their funds into play only after it becomes effective. Some people would do preemptive buying, but this is largely a list of names which you should focus on the expected estimated inflows as per what the Motilal Oswal note says. Now, a lot of names out here, some of which are expensive, some of which are not. Mayuresh, I want to come to you on two names out there in that list that we just showed. One of them is DLF, which is seeing some consensus upticks in its price targets and is likely to see substantial inflows. The other one is Colgate, which has taken a bit of a beating in the recent past, but could see some buying.
So I think both the elements here, Neeraj, have some issues to address. DLF, for example, I think when you're probably talking about the entire inventory, that probably still stays on the higher side, specifically in the regions that it operates out of. And though there is every hope that there might be some liquidation happening over the next few months and quarters, how the pricing element actually plays out and how the clearing of this inventory actually happens is going to be extremely critical. The second element obviously is how their annuity business actually shapes up. So I think that has held up pretty well for them in the past. But again, I think the kind of expectation that one really has in terms of new additions probably happening, and even the new additions in terms of sales velocity of the residential side of their business, I think that is something to be seen. The second element and the other sphere that you're talking about in terms of Colgate-Palmolive, I think the numbers have held up quite okay so far. So what you've probably seen in terms of gross margins, what you've probably seen in terms of EBITDA margins and the market share, both in terms of toothpaste as well as toothbrushes are concerned, I think it did see those market share to competitors as well. But I think the Ayurvedic portfolio coming back, the expectations of them actually able to stabilize and maintain their market share at the current juncture, and expectations of gross margins expected to remain around the similar levels. I think those are some things that need to be observed over the next few quarters. No question about their earnings profile. I think the return ratios are fabulous as always. What they're doing in terms of valuation, tad bit on the higher side. But I think it does deliver numbers a tad bit below expectations in the past few quarters. But again, I think it should normalize going forward as well. So the flows are obviously going to benefit both these companies going forward. But if I have to pick and choose, probably consumption as a basket and Colgate as a stock would still be a preferred one.
Okay. Let's also bring in our technical experts on the show. Brijesh, Bhatia, research head at Dealmoney Securities, is joining us right now. Brijesh, very good morning to you. Let's talk about the index at record highs once we get there. If we do a pre-open or maybe post-opening, but it looks like it's just a stone's throw away, and the probability stacks up in favor of us crossing that record high. What's the trade going to look like then?
Good morning, Devina. We have been trading in quite range for around 11,800, 12,000 for quite some time. I would say nearly 11, 12 sessions. We had a range bound trading going on, and in yesterday's session we broke out of that range, ended at a good about 12,050, which was the resistance zone, and I think we are breaking out with the good momentum. And if I just add on with the derivative structure, we have seen huge unwinding coming in with the 12,000 calls, which had a good run in the nearly 2 to 3 weeks. Options writer had good days. Now we have seen yesterday unwinding to the tune of around 21 lakhs of OI on the call side, and they have clearly shifted to the higher range, which is around 12,200, 12,300. But simultaneously, if I just look at the put structure as well, so we have seen huge rating coming up around 29 lakhs on 12,000 puts now, so which indicates that a strong support might act as a 12,000 level. So I would go long at the opening at around 12,073, which was the last yesterday's close. Look for target of around 12,218 to 12,279 on the spot levels at the higher side, and keeping a strict stop loss of below 12,000, which is around 11,985.
Okay, that is a quick call on the index. Shrikant Chouhan, Senior VP, Technical Research at Kotak Securities, is also here with us in our studios. Shrikant, good morning to you, and a bright and positive day. Would you also be in the camp that suggests going long?
Yeah, good morning. I think, we were of the view that the market it was like consolidating between the range of 12,050, 11,800 on the downside. And eventually yesterday the market has broken this level. And the best part was that yesterday we saw hardly any activity in all index heavyweight stocks except HDFC Limited. But the broader market did extremely well. So it clearly shows that the strength is there and the bottoming phase is happening in the market, at least for Nifty 50, Nifty Mid Cap 50 or NSE 500 shares. At the same time, the way the market has taken time to cross the level of 12,040, one thing is very clear that we are heading for the levels of at least 12,200, 250 in the near term. So again, it's a 2.5% sort of rally from current levels. And in case if we see any drop from current levels, will be an opportunity to add some long positions close to 12,040, 50 levels. Today, maybe close to 1030 levels. If there is any specific news flow on the Maharashtra elections politics, then we may see some swings in the market. But in that case, if we see any drop close to 12,040, 50, it will be a very good opportunity for short-term traders to create long positions with a stop loss at 12,000. And on the higher side, the immediate target is 12,150.
Okay. So in a scenario like this then, what are the stocks that one should bet on? Shrikant, let me come to you first, then we'll go to Brijesh. What are the stocks that you're betting on today?
We are betting on those stocks which are not part of index or which are very close to their important long-term supports. So Chola Finance, which is close to 315, 317 levels, is showing a lot of strength. And yesterday we saw very good activity in almost all finance companies. Today we are expecting activity in Chola Finance. It is around 317 levels. We are expecting 335 on the higher side. We can keep stop loss at 310 on the downside. The other stock which we like is Britannia, and it was around 3,500 levels. From there, all the way the stock has fallen to 3,020, 30 levels. So here also, with the stop loss at 3,000 for intraday purpose, we should look for adding long position in Britannia with a target of 3,100 on the higher side.
And Brijesh is actually betting on both the index stocks. So we have variety today. Brijesh, two names, wondering if these are positional calls or short-term calls. Axis Bank as well as Reliance Industries.
Yeah, Neeraj. So I would say let's start with Axis Bank first. So if I just look at the structure, stock was consolidating since the start of the November between 750 and on the downside was consolidating at the lower level of 700. So it has formed a bullish head and shoulder, or I would say running head and shoulder, and indicating that the momentum which is with the index now, which has broken out of its cup and handle, in Axis Bank also would lead the rally now. And if I just look at the volumes yesterday, it was very good volumes in the yesterday's momentum session, forming the candlestick is rising three candlestick pattern. So I think a good bet on the Axis Bank, keeping a stop loss of 730 on the downside, and upside targets of up to around 815 can be expected on the Axis Bank. This would be a trade for around 4 to 5 trading sessions on Axis Bank. Second, if I look at the Reliance post momentum got a gap up opening, consolidated for 3-4 sessions, retested the gap. And if I just look at the yesterday's session, it made a nearly open low same of around 1551 and continued its momentum towards positive territory. So at around 1561, one can take a long bet, keeping a target of 1635 on the upside, and stop loss can be placed at slightly below the recent low of 1528.
Okay, those are some stock ideas that you need to keep in mind ahead of open. But on to a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock today?
Morning, Devina. So we're looking at Bank of Baroda and a considerable amount of strength coming into the counter. It's now quoting in three figures, and the trender indicator that has given a positive signal on it. Now the trender, as you know, is a proprietary Bloomberg indicator and basically uses the average true range for the purpose of generating a buy or a sell signal, and it also helps you manage your stop loss. Coming back to the price chart of Bank of Baroda, what we've seen in the last couple of trading sessions is that it has managed to creep above the mark of the trender, but did not successfully close above it. And the condition is for the trender to change its color or give a signal is when the stock manages to close above or below the mark of the trender. Now, the red line of the trender, it's at the mark of 99.5. For the last 3 trading sessions, it made intraday swings above that mark, but it managed to close below it. And yesterday, we saw a decisive close above that mark. It is quoting at about 100.5 currently, where it closed in yesterday's day of trade, with volumes too being fairly high. Additionally, when it comes to the longer term chart of Bank of Baroda, what we are seeing is an interesting pattern on the weekly charts, where it had made a base around the mark of 85.65, which is a long term support zone, support for the stock. And there, if you draw the retracement of its fall from 132 to almost 85, the 61.8% retracement comes to the mark of 115. So that is at least the minimum upside that one could watch out for in Bank of Baroda. Additionally, when you look at the RSI as well, when the stock had bottomed out around the mark of 90, the RSI had given a lower low on the stock in the weekly time frame. So even though the stock moved lower from that mark, the RSI made a higher low. So that is another indication of the increasing strength in the counter. So on the longer term charts also, there is a bullish signal with the RSI giving a positive divergence, and the 61.8% retracement indicating a very high upside, almost 15% from its current market price.
And how has this worked in the past, Yash?
So for the trender indicators efficiency, 3 out of the last 5 times that it has given a positive crossover over the next 1 month period, the closing basis returns have been close to around 6%, but on an intraday basis, again, we can see big moves for the counter because the kind of volumes that it sees on a daily basis.
Okay. Thanks a lot for that, Yash. We'll watch out for that stock. And since we were on the topic of DLF, I just want to throw it open to our technical experts to see whether or not there's a trade possible on DLF at the open this morning. Shrikant, why don't you take that?
I think, see, DLF is already into overbought zone. It was around 130, 140 levels. From there, all the way it went to 220, 225 levels. And yesterday, there was some reversal pattern. But it shows that someone has taken active interest in the stock. So if there is medium to long term view, I'm going to say if there is a view of at least next 15 to 20, 25 days, then only one should look for adding DLF even at current levels. But if there is a very short term view, then just wait for the opportunity, because the stock can slide to the levels of 205, 200 on the downside. And there the stock is having very good support in terms of retracements and extensions. So it is better to buy on declines instead of buying at current levels.
Okay, DLF there. Mayuresh, I just want to come to you on some of these housing finance companies. Now, while obviously Indiabulls Housing Finance is on a trip of its own, but it's a very volatile stock nonetheless. It'll be like catching a falling knife. But a stock like LIC Housing Finance too has gradually been moving up and is probably creating that kind of investor wealth as well.
Oh, it is, Devina. And again, I think if one really has to pick and choose between housing finance companies, I think the kind of advances distribution that they probably have, I think the profile that they probably cater to remains extremely critical. Now, for companies like an LIC Housing Finance, I think the retail portion still remains extremely high. Though over the past few quarters, they have ventured into LAP and builder financing as well. But I think there has been some element in terms of asset quality issues actually cropping up. But again, I think that's for the industry as a whole. So yes, I think anybody who has been invested into LIC can very well hold on. But again, I think what we probably like, as I've always mentioned in the past as well, I think Canfin Homes is something where we believe that if one buys over the next few days and weeks, I think let the stock actually make a move of 4 to 5%, because then it will be close to our pivot levels that we're looking at as an exact buy point. I think it looks sufficiently placed both from a supply demand perspective as far as the volumes are concerned. And when you're probably talking about the fundamentals itself, I think the NIM's expected to remain stable going forward. What they've done in terms of reported asset quality numbers, I think that should stabilize around the current figure as well, which basically means that as they're expected to grow their book, and again the ticket size thereof, I think it's pretty reasonable, and the profile to which they lend, I think it probably looks like a pretty reasonable and a decent business and the balance sheet that they're probably carrying over the next few quarters. So yes, I think anybody holding on to LIC can definitely hold on, but for Canfin Homes, I think another 5-6% move exactly close to our pivot points. If that pivot point at the current juncture over 5% is taken off, I think the stock can actually deliver good returns as earnings can be quite good over the next few quarters.
Okay, now some data, and interestingly, since June 3rd when the Nifty hit the life highs, then only 2 sectoral indices have actually delivered positive returns, which is financial services and FMCG. Almost everything else, auto, real estate, pharma, IT, and even PSU banks have languished. The key is, can some of these indices make a bit of a comeback? And we'll wait and watch if that happens or no. Some of the stocks in these indices, which are top of the mind, are names like Berger Paints, which again, as per the MSCI rebalancing, might see a bit of an inflow. So do watch out for Berger Paints in the session today. And then because of the weightage increases, we might have some inflows coming in for a stock like ICICI Lombard. So these are 2 names that are interesting. Now, Mayuresh, fundamentally, I mean, I don't know if there is enough valuation backing for a Berger Paints trading at it is at 70-75 times. But ICICI Lombard, fundamentally, Mayuresh, is there a case for buying this one?
Oh yes, and we believe so, Neeraj. And again, I think if you probably look at the business argument and the model on which it is based, I think there is huge scope in terms of penetration, specifically in terms of the general insurance products. For most players that are operating out of this area. The second element obviously is the conscious reduction in terms of the crop protection plans that Lombard has done. And now all the general insurance companies did take a hit because of the irregular monsoons that we saw and the claims thereof. So I think the combined ratios for most of these players did shoot up above that 100% kind of a mark. But I think the conscious decisions to probably pare this down and the expectations of motor insurance, both own damage, third party, as well as health insurance, I think these are 2 spaces that can do extremely well going forward. The third element in terms of the entire distribution network and the bank assurance types that they probably are entailing going forward as well, I think that creates the foothold that is probably required to probably entrench into tier 3, tier 4 cities and towns as well. So I think the earnings should start holding up going forward. What you've seen in terms of the potential for the business to deliver still seems to be pretty large. The private space, and again, I think this is a very niche player thereof, I think it should maintain and in fact keep on gaining market share going forward as well. And that should reflect very, very positively in its earnings going forward as well. So yes, I think we remain extremely positive on ICICI Lombard over a medium and longer term.
Well, that's one stock that you need to monitor because of the MSCI rebalancing as well. ICICI Bank is the other one, large inflows anticipated. Some of it could have been preemptive, so keep that at the back of your mind. Stocks which are doing very well for themselves included InfoEdge, which is also going to see an inflow and could be, has done largely well. This 1 month as well, about 16%. It's not usually a trader-friendly stock as much because it's a slow mover, Shrikant. Would you trade an InfoEdge?
Yeah, it is showing a lot of strength. In fact, it is forming a higher top, higher bottom at very short interval, which is positive, and it shows that like very strong conviction is there for someone who is taking active interest in the stock. I think it is heading for the levels of at least 2950, 3000 in next couple of weeks. So it will take time, but it's a buy at this price. I think the stock has made fresh bottom close to 2500, 2550 levels. So with the same stop loss, if we create some positional trade on it, then we can see the levels of 2950. That's the view on InfoEdge.com.
Okay. Brijesh, a quick take on L&T Fin Holdings yesterday and the day before that, I think, was an active stock.
L&T or L&T Finance, Devina?
Yeah, L&T Financial Holdings.
Okay. I think I would look at the long bets on this, because if you look at the resistance, it was quite holding 100 levels for quite some time, and we have seen a good momentum coming above 100. And most importantly, this is the first time we have seen good closing above the 100 days moving average since May. So I think momentum might pick up, and the volumes were nearly at 15 days highest volume. So I think a good bet towards 110, 112 could be expected on L&T Finance.
All right, it took down some of its, shorter-term moving averages as well. The 100-day moving averages surpassed that. So Brijesh is moving towards 110. This is Asia for you. The setup, I think there has been a slight pickup, so we've flattened out for China and Hong Kong, while Japan still holds on to gains. SGX Nifty is improved about 26 odd points now on the SGX Nifty, 12,133. So pre-opened on your screens for the index, and remember, while this is definitely a new high, this is just the first instant, the first tick that you're seeing on pre-open. We're going to wait for this, but it's a big gap, about 1/3% or so. So most likely, this is going to stick. About 1/3% on the Nifty 50, Sensex higher by about 0.5%. But we'll come down to the index again in a few moments, down to individual stocks now, and it looks like Zee is once again at the epicenter of this move. Right now, at least, the stock's moved up about 10% odd. Yes Bank is up about 3% odd. ICICI Bank 509. Remember those MSCI weightage balancing, and the changes will lead to an influx of funds into ICICI Bank as well, much higher than what the rest of the other components will see. So this too is up at 510. Tata Steel, Hero MotoCorp, Tata Motors, ITC, SBI at 337. BPCL moves up. TCS, everything is looking okay at this point. Something that's not doing well are yesterday's big gainers. Bharti Infratel sees some profit taking, I guess, and along with the Bharti Airtel. Titan is looking slightly weak, and Bajaj Finance is at 4,120 now. Ultratech Cement too is down about 1/3%. So, it looks like, and if you can get the index back, we're just about there on the index, just holding on to those initial hits that we made. Bala, Chief Market Technician at cashthechaos.com. He's joining us on the show as well. Jay, thanks very much for taking out the time. We've got an initial hit. The market looks like it's going to sustain it. At least the first few minutes are down. We're going to wait till the end of pre-open. But in the likely case that we do see and maintain these record highs, what should the way forward look like on the index?
Yeah, good morning, Devina. I've been saying for some time, a couple of months now, that you should be participating in this rally, but whether it's a new high or if it's just a lower top, you should be participating in this rally as a trader and not as an investor. So even if a new high comes, this market has got a couple of problems. Let me highlight it for you. First, the number of stocks hitting 52-week highs to the number of stocks hitting 52-week lows. Yesterday it was 1:5. So that's just not in a one-day occurrence. It's been happening since the end of October, or middle of October to be precise. So the ratio has been somewhere between one. The best ratio has been 1:1.5, favoring the stocks hitting 52-week lows. And the second thing, if we assume the new highs are coming today, it'll be 60 sessions from the 2019 low of 10,637, whereas the fall from 12,103 took just 56 sessions. So the rise is actually slower than the descent. So that is saying the bulls have considered some space, which is not a good sign. It's just saying the ease of movement is much labored when it's going up. So am I discrediting the new high? No. But the point the market is telling you, and we need to pay attention, is that don't drop your guard. Although new highs could come, don't drop your guard. Stay with it. Have trailing stop losses. And the market has used all the firepower of Reliance, Bharti, ICICI, HLL, TCS. Yet only now the market is just eking out the fresh record highs. The fresh record highs on the Sensex came about a month ago, and the Sensex is gasping and heaving to keep just 1% above it. So, this is telling you a sign of caution. Once again, I need to present the global picture. I'll give you a quick, important data point. The number of short positions on the VIX, basically people are not anticipating volatility. That's at record high. So although the U.S. markets are at record high, such complacency is not good. At least a top, if not the top, is likely, and we could see some sizable correction at least come through. So at this point, it's time to be a bit cautious. Don't be bearish yet, but let the reversal come through if it's going to come through. So, but be cautious, stay on the edge.
So in light of that, Jay, what are the stocks that you're betting on? I mean, I'm guessing you're still batting for the upside on specific stocks.
That's true, Neeraj. And I like IT space minus Infosys. So I think HCL Tech is a good stock to be in. So one can place a stop below 1100 and expect it to touch somewhere close to 1185 to 1200. And I also like TCS, and TCS, once again, yesterday's low, I think it's going to hold. But I like HCL Tech over TCS in the short term. And I think TCS could go back somewhere close to the record highs it made about around 2300. And I also like PVR, and PVR is looking quite positive. I think it's bound for a fresh all-time high around 2050. And I'll place a stop just below about 1680 and hold on to it for a fresh record highs to 2050.
Okay, Jay, we'll leave it at that. Thanks much for taking the time out and being with us today. Appreciate your time. Be cautious is what Jay Bala is saying. The views may differ. I think Brijesh and Shrikant not sounding any caution signs right now. They are bullish, but we'll get those conversations going. We'll get in more market voices as well as the pre-open rates suggest for now that we might start off at those record highs. Agam Vakil Johnson with the top brokerage calls for the morning today. Agam, good morning.
Good morning, Neeraj. Well, I have a downgrade and an upgrade, all from Goldman Sachs. I'm going to start off with Goldman Sachs on Nestle, where it has downgraded Nestle to a sell from a neutral with a price target cut to around 10,642 from well over 11,600. The reason is they suggest that there could be increased competition in Nestle's biggest category, that is packaged foods. They see limited room for further improvement in growth trajectory for other segments as well as far as Nestle goes, and they expect Nestle to underperform driven by slowing growth in milk products and the nutrition segment. On the other hand, Goldman Sachs has also upgraded United Breweries to buy from a neutral and hiked its price target to 1,423 from 1,280. Now, they expect margins to rise in the near term on lower costs, revenue mix and high utilization. They also see long-term secular volumes growth remaining intact. And the recent pullback is an opportunity to accumulate in the market leader in the beer. That's according to Goldman Sachs on United Breweries. So, well, two very different calls coming in from the consumption space when it comes to Goldman Sachs' view on this.
All right, we're at the end of pre-open and it looks like these prices stick. And for pre-open at least, we've got 12,110. So this most likely is going to be a new record high.
Yeah, likely. Still a couple of minutes left, but yeah, I mean, maybe a minute left. But yeah, Devina, you're right. 12,110. We're likely to knock at fresh highs on open.
Yep, Basant Maheshwari, partner and co-founder at Basant Maheshwari Wealth Advisors, is joining us right now on the show. Basant, thanks very much. You know, we really had very interesting conversations with you in the past, and in and around those record highs now for the equity markets. You know, we've spoken a lot about what the government has done, the government has heard, you know, the measures that they've taken and what it's done for the equity markets now. You know, now it's uncharted territory, so we are going to, you know, make a path for ourselves. What's it likely to do, according to you, and the excitement around equities, even from foreign investors? Is it likely going to come back in a big way?
So, you know, two things first. I mean, it's again a story of two halves. The two halves. One is the guys who have it, and the one is the guy who don't have it. So, if you look, the Nifty is almost at its all-time high. It might break it today, tomorrow, day after. Doesn't matter when it does it. But the small cap index is down, I think, around 40% from its all-time highs. Portfolios are still bleeding in the red, and that's the real problem. But then from the foreigners' perspective, if you see, the foreigners are still net short in the derivatives market. They haven't covered their shorts yet. And if you go by anecdotal historical evidence, till the time foreigners go net long in the derivative markets, Nifty doesn't sustain its all-time highs. So either the foreigners have to come and cover back their shorts, or we'll just keep flirting around these 12,000, 12,100 levels. But for us to decisively break through and move towards 12.5 and 13,000, which we expect that should happen over the next 2, 3, 4 months, the foreigners have to come and buy big time lock, stock and barrel. So, but then that's the thing to be watching out for if you're a Nifty observer. But if you're in the mid and the small cap, then the story is almost the same as it was 6 months back.
But does this probably give you, you know, some amount of confidence that while a bulk of those stocks is still doing what they're doing, the ones that have been, you know, the ones that have been able to wither this, you know, test of fire sort of thing have done well? And you've seen many of the mid caps and small caps also running up almost 50% in the year.
Absolutely. And now it's back to those things. things which will be which will show performance in terms of numbers will get performance in terms of prices. So it's a very selective market, a narrow market, a focused market, a market which respects earnings, a market which goes up on earnings, and there's no question of hope right now. So I mean that way, if you are buying companies basis earnings, I think you'll do fine. You're doing fine for the last 2, 3, 4 months. That's not a problem. But there is no broad-based buy all kind of stuff right now. You go and you buy anything and it starts going up. So I don't think that's going to ever happen over the immediate short term. But over the medium term, I think the government has decided to do something for the budget. And this is an anticipation of the pre-budget rally. If some big bang announcements come during the budget, I think the market will rally before. Salute the government for that. And post the budget, when the news comes out, I think we might have a correction. But this is just the start of a pre-budget rally. I think something big is coming in the budget. That's what the screen is telling us.
Interesting. And Basant, I was going to ask you that because you read the screen so well. Now, your screen reading in the past, I remember, has told you to stick with those high-quality financial names despite they looking expensive on the face of it. Now, my question is, the last 1 month, the screen is also telling us that there is some activity, not necessarily in the low quality names, but some of the beaten down names which have started to participate. The risk reward from here on until the budget, or maybe if you're playing for the pre-budget rally or for the next 6 months, is it more skewed in favor of some of those names which have now lately started to participate, or would you still stick to the tried and tested?
Neeraj, if you look at it in the past, the leaders move first, and then people buy the second line, the third lines. Then the leaders move again. Then you go into the second lines and the third line. So from September 20th, so maybe till first week November, it was the leaders that were just moving up and nothing else was moving. They had their first bout of buying. Now the buying has shifted to the other names. But then, for example, no recommendation. If you go and buy a DLF, let's say, for example, today it might go up 250, 300, whatever. But then if it falls 10%, you wouldn't know what to do with it, whether to average, whether to get rid of it, whether to buy more of it. So you don't want to be in those kind of companies where even with a 10% downtake, you're completely unsure of what's the next strategy going to be like. So, it's great to write a value investing thesis on buying the beaten down, the cheap names and all those kind of companies. But the key question to ask is, what are you going to do tomorrow if the stock falls 10%? So those are the kind of issues we have to grapple with. I think it will still be sensible enough for people to just look at the companies that are delivering earnings and stay with them, rather than try and make that quick 20%, jump off some random trade like that.
All right, Basant, advice well taken. We're just 2 minutes away from market opening. We'll let you go on that note. Thank you so very much for joining us. So, that's the word coming in from veteran investor Basant Maheshwari. We're just minutes away from market opening, so let's tell you all that's there to watch out and trade today. Subhash Chandra has stepped down as chairman of Zee Entertainment with immediate effect. He will be on the board as a non-executive director. Debt-laden Reliance Communications gets bid from Bhatia Airtel and 2 other players. Thomas Cook will demerge its human resource business to Quest Corp. Each Thomas Cook shareholder will get 1889 shares for every 10,000 held. Dish TV, NBCC, Tata Motors DVR and Castrol will be excluded from the derivatives segment from January 2020. The government has asked Interglobe Aviation to gradually ground unmodified A320neos, according to Bloomberg. And lastly, Goldman Sachs has downgraded Nestle to a sell from neutral. It has also cut its target price to 10,642 from 11,622. What it has also done, of course, is upgraded UBL. Brijesh, Bhatia, come in on this one very quickly before we get in your top calls. A word on United Breweries. Does it look apt for a trade?
No, Neeraj, because the stock has been trading in a range, so I would slightly avoid. In case it rises towards 1246, I would look for a short opportunity.
Okay. Well, we are about a minute and a quarter away from the open, and Devina, it'll be very interesting to see if we do hit those pre-open levels and start off at record highs. That calls for some rejoicing. Yeah, it does. But let's also get in those top ideas before we start counting down to open. Shrikant, let's start off with you first.
I think, apart from Cholamandalam Finance and Britannia, we also like ICICI Bank. We yesterday closed around 498, 499 levels. Today it is opening around 502. We are expecting 510 to achieve in today's date. So buy at current price with a stop loss at 497.
Okay, quickly, Brijesh, Bhatia, what's your top call for the day?
Apart from Axis and Reliance, I would go long on Mosil. Stock is from bullish, reciprocal is equal to 3D, and one can go long at 104, keeping a stop loss of 102 and look for 107, 108 on the upside.
Wow, after a time I'm seeing no sell come in. Okay, gentlemen, maybe just stay on. We'll take in opening thoughts from you very, very quickly. When the market start off, we start off at new highs and we march on further. Remember the last few days, while the pre-open session is tentative, the open is actually at times much higher as well. So let's wait and watch if that happens. But we are very likely to start off at record highs for the Nifty 50. And after a period of about 5.5 odd months, we'll be back at those levels once again. But here are the first trades. And yes, we are at record highs, 12,111. Well, cat calls, wolf calls, whatever you call it. It's not as gung-ho, but it is a start in the green, which is a great sign. About 1/3% for the Nifty 50. Sensex about 121, about 126 odd points higher. And Nifty Bank about 106, about 1/3% in the green. Usually the color green brings about a bit of a cheer. I mean, the people who are bearishly placed might not cheer this, but this is a good sign really for almost everybody else who is long only. Get the mid cap and the small cap indices as well. About 1/3% for the mid cap 100, the BSE small cap about 1/4%. So yes, we've nudged new highs, but we're staying slightly subdued. It's not a start which is a rara start which has started higher and then gaining, but these are initial ticks. Let's wait and watch. Let's give them a chance to stabilize. But the color of the green is right up there. The advance decline ratio firmly in favor of the advances. 39 stocks advancing, 11 declining. But let's start off with the gainers because it's a start in the green. Yes Bank about 1.73%. Hindalco, Tata Steel are amongst the metal names which have done well. ICICI Bank, MSCI rebalancing, weightage going up. Maybe that is leading about 1.1%. Gains in ITC, Reliance Industries, and IT too is doing well with the likes of HCL Tech and Infosys, for example, in the green. So the going is looking strong for now. What is not doing well are two names. Bharti Infra down about 5%. Yesterday was the top gainer. Today down 5%. Bharti Airtel, the second best performer yesterday, down about 1.5%. And Zee continues to languish about 1% lower in trade. The only banking name, by the way, which is in the red, or two names are IndusInd Bank and Kotak. But otherwise, the mood is sanguine. And now we are building on, Devina, about 0.5%. 12,123. Now we are in a slightly better shape on a day when we hit new highs.
Yep, that's what you have. A day where you've got a new record high on the index. We'll try and get you as much market perspective as we can to make sure your investment decisions from here on are more informed. But taking a look at what the mid-cap and the small-cap index is doing right now and the stocks that are moving thereabouts, you've got Thomas Cook, which is right at the top of the Nifty 500 list. It's up about 9%. You've got Arcom, a penny stock, but that's still doing okay. Magma FinCorp at 45, that's up 5%. Indiabulls Housing continues to soar. Something's happening here. The stock's been up about 20 to 25% in the last 3 trading sessions, including today, it'd probably be 30. It's a 272 on Indiabulls Housing. You've got DB Realty, Indoku Remedies, and the list goes on. So I won't probably dwell on each individual stock, but the breadth of the market is also extremely positive. 800 stocks have advanced and just about 300 stocks which are trading in the red. So this rally's got its own backing.
It does have its own backing. And very quickly, before we get in, Saurabh Mukherjea, very quick thoughts. Shrikant, 30 seconds. Something that pops up on your screen right now, we are at record highs. Would you buy the Nifty? Would you buy some specific names?
I think, there is no point in buying Nifty at these levels because it is already up by 150, 100 points from current levels, and there is very limited upside for the higher side. But yes, we can certainly take some risky calls like buying Yes Bank or buying Indiabulls Housing Finance because they are into breakout formations. In fact, such type of formations we never seen in the past for this type of stocks. Yes Bank especially, which is trading around 64, 65 levels. There we have a bullish call. We feel that it is again heading for the levels of 67, 68 from current levels. And we can keep stop loss at close to 62 rupees.
Okay, Brijesh, very quickly, Nifty Bank, before we thank you, Nifty Bank about 136 points higher. Can it do more and can it hit its record highs too?
Yeah, definitely. I would go long at current point of time also and keeping a stop loss of 31,468 on the future side and look for 31,950, 32,000 on the upside.
All right, gentlemen, we'll leave it at that. Thank you very much for joining us this morning, Shrikant as well as Brijesh. Wasting no time, bringing in Saurabh Mukherjea, founder of Marcellus Investment Managers. He's joining us right now. Saurabh, very good morning to you and great to have you on a day where we actually made a new record high. But do things change materially from here? Or this is just, one more level that we have crossed, one more hurdle that we have crossed. Though obviously on ground, we've not really seen a big change in fundamentals as such.
I think, look, this is familiar territory for India insofar as if you look at our stock market history, 80% of the gains in the stock market have come in the 2 years following general elections. So in the 2 years following general elections, if you take the last 10 general elections, in the 2 years following elections, the stock market's given on average 27% per annum compared to the long-term average of 14 odd percent. So nearly double the returns in the years following general elections. And the reason this happens is also very familiar. This reason this happens, typically economic reforms come in the aftermath of elections. The stock market discounts the benefits of the economic reforms. The stock market rallies a good 1 to 2 years before the economy picks up. So very familiar territory for India. We were here in the early 80s, we were here in the early 90s, and once again, as we approach the end of 2019 and we approach the beginning of a new decade, we are finding ourselves in territory where the stock market is discounting economic reforms before the economic growth actually begins.
So what's your advice now, Saurabh? How do we tread these markets? What's happening on ground, economic indicators completely divergent from what the equity markets are doing right now. And probably I would read it as a silver lining that we've reached these record highs without any support from foreign institutional investors who still in the derivatives market are short. They're covering their short, but there's still some time to go now. Would you say that leaves a lot more headroom for foreign investors to come in and propel the markets even higher?
So I wouldn't really worry about whether foreign investors come or don't come. I think the way money has been made in India over the last 30 years is extremely clear now. And I think we just carry on doing that. Your viewers can carry on doing that. Nobody out there, myself included, can suddenly become overnight an economic expert and second guess which quarter, which month the economic recovery will begin. I don't think that's a practical, feasible exercise. What we can all do is identify companies which have clean numbers, fabulous franchises, long track records of making lots of money for investors. Those stocks are out there, we go and buy them, and as we've discussed before, people who look at PE and try to make investment decisions typically struggle in India because you're constantly second guessing the PE multiple, which is not a clever way to invest in our country. But on the other hand, identifying great franchises, clean numbers, high barriers to entry, very doable exercise. Your viewers can do that and buy those stocks and hold your nerve through what is clearly a very difficult economic climate. Hold your nerve, buy these high quality names. Indian history shows you'll make healthy returns even if the economy takes longer to recover than anybody expects.
Saurabh, good morning, and well, to all bulls out there, congratulations, and you guys are managing a lot of people money, so good for you as well. The question is, at times of excitement, does it help to buckle down and be boring? Because we were speaking to Rakshit a few days back, and he said that we love being boring in these markets as well because that is what is making money.
I think in all times, whether it's exciting times or fearful times, it pays rich dividends to be boring in India, because this is an economy, this is a polity which generates enormous amounts of risk. Our political system, our regulatory system generates enormous risk for investors out there. Our economy is still a underdeveloped economy. A per capita income at $2,000 per capita is lower than most sub-Saharan African countries. We are a poor country. If in a poor country with a volatile polity, you go out there and take risk, it's very difficult to make money. On the other hand, you compress risk. You don't take balance sheet risk, you don't take franchise risk, you compress risk, you make very, very healthy returns in our country. That's been our motto for ourselves, for our clients, and it works. It works not just for making money. Making money is incidental actually. It works in terms of keeping our nerves and our clients' nerves in check. You try to take risk in the Indian market. I think I remember telling you guys in an interview 2 or 3 months ago, you try to take risk in the Indian market, you're typically carried out in a stretcher.
Saurabh, does the approach to building the portfolio change now? Throughout our conversations in the past, we've spoken about financials, we've spoken about consumption stocks, stocks which are catering to essentials for the mass of India. Does that change? Do you want to build in a little more risk into the portfolio?
No, not really. I mean, I think we've got to remember what is the nature of the economic reform process we find ourselves. And I think the nature of the economic process, the reform process in India over the last 3 years, around GST, around Demon, around the recent corporate tax rate cuts, all of this is suggesting that the entire economy will get concentrated into the hands of a few market leaders. By market leaders, I mean economic market leaders, not stock market leaders. So if you are Asian Paints, these reforms are incredibly positive. The entire informal paint industry is going to fold up and you're going to be a massive beneficiary of that. Ditto for Pidilite in adhesives, ditto for someone like Relaxo in footwear, right? So the entire thrust of the current bout of reforms that we've seen from the NDA over the last 2 to 3 years is suggestive of economic power being concentrated into the hands of a few large companies. They benefit big time from this process, and it therefore behooves us to invest our clients' money in such companies. Now, such companies they could also be in B2B. They don't necessarily have to be just consumption plays. And our job is to find such B2B companies as well. I think we found a couple. We're looking for a couple more. And I think that's the only change we'll make. We've now, it's now relatively clear how the NDA wants to change the country. It's taken us 6-7 years to completely figure it out. But now that it's relatively clear how the NDA wants to change India, it behooves us to look for companies, not just in B2C, but also in B2B, who will become sector dominators, crush the smaller players in the sector, and build very lucrative, very profitable franchises.
Saurabh, we are looking at some data points, and the percentages and the points might be a bit different. But when you look at companies which have largely done well from the last time we hit the highs, which is on June 3rd until now, at the mid-cap 100, the likes of Info Edge, Voltas, Berger, Tata Global, Jubilant FoodWorks, all of them distinct flavor of consumption. At the large cap arena as well, you have financials largely and Reliance Industries and maybe to an extent HUL. The classic adage is that the leaders of the previous rally don't necessarily lead the next rally. With the presumption that over the next 2 years we will be higher from where we are right now, would you believe that the set of leaders will change, or would you believe the same old will continue to move higher because the earnings momentum and the valuation uptick in some of those is not done yet?
So there are lots of grandmother stories around which the Bombay stock market sort of hinges and tells people in the market tell each other stories around these sorts of things that leaders of the previous rally won't be. But if you look at HDFC Bank, 270x up or 280x up since 1995. I think we've had the late 90s rally, the noughties rally. Now then we had the post Modi rally. Now we're having, I guess, the post Nirmala Sitharaman rally, if you want to call it that. In every single rally, HDFC Bank has made bucket loads of money. HDFC Bank, the 2-year CAGR in the years following general elections, the 2-year CAGR for HDFC Bank is 52%. So I don't know which rally we should refer to, but every single rally I can find in Indian history, HDFC Bank has made buckets of money. Similarly for Asian Paints. Asian Paints' PE multiple 20 years ago is what it is today. In this intervening 20 years, this company has made the best part of 100 times for investors. So we can keep trying to figure out when will the capex cycle start, which capex play should I build on, when will the economic recovery start, which high beta play can I build on. Those are interesting intellectual exercises to indulge in. But in terms of making money, I think the message from history is loud and clear. The 2 years following stock markets is when the bulk of the money is made in the Indian market in generality, and especially in the case of high quality compounders such as Asian Paints, such as HDFC Banks. The 2 years following stock markets tend to be extremely fruitful. I'll put it another way. I haven't found a single 2-year period following general elections in which money has been lost in India, barring one. The dot-com bust was the only 2-year period following general elections in which money was lost. So typically the Indian market long-term returns are 14-15%. In the 2 years following elections, the returns are 27%. These sorts of consistent compounders, Asian Paints, HDFC Bank, disproportionately participate in such rallies. High beta names, wax and wane, very difficult to time them, very difficult to second guess them.
Saurabh, get your point, but if only investing was all that simple, we'd all be sitting on truckloads of money right now. It's still difficult.
It is. So it's one of the things our profession does. Our profession deliberately characterizes investing as being some incredibly difficult dark art, so that we can convince people out there that you need to give us your money because it's incredibly difficult. Actually investing, high quality investing is relatively simple, and hence the book, hence Coffee Can Investing as a book. We try to simplify it for people so that hardworking people out there who are watching this program can take their money, read Coffee Can Investing, and responsibly, cautiously, conservatively save, invest money for the long run and enrich themselves. It is no great science to invest cautiously, conservatively, and make healthy returns in what is still a poor economy with plenty of growth potential.
Okay. So just let me talk on behalf of an investor who's probably not got 50 lakh rupees to invest in Marcellus right now. So someone who's probably looking at making and forming a portfolio for themselves.
Absolutely, yeah.
It's a question that keeps coming time and again. While savvy investors like yourself have spotted those value generators, it's difficult for a retail investor to put money in an Asian Paints when it's priced the way it's priced, or an HDFC Bank saying, oh, kafi bhag chuka hai abhi, let's just give it a break, let's see it come down a bit and then I'll invest. So is that the area where they miss out?
Right. So I think what does happen is, although we've written Coffee Can Investing, it's easily available. People buy it on the internet. It's available in bookshops. It's not very expensive to buy, and people don't have to come and give Marcellus money. You can read Coffee Can Investing. You're right. What happens is, investors read our book. Retail investors read our book. Then they look at the newspaper and they read, oh my God, Asian Paints has run up and HDFC Bank has run up. What do? Let me buy some third-rate high beta name recommended by the local broker. 6 months down, that third-rate name is down 40%, and the investor loses heart, and he ends up running away from the stock market. That cycle is devastating for retail investors. They shy away from the HDFC Bank, Asian Paints type names because the PE multiple looks optically high. The broker discourages them from investing in it. They go towards the speculative names that the brokerage community loves pushing. They lose money there. They run away from the stock market into the false safety of fixed income products, and then over time their wealth compounding falls behind their aspirations, and before they know it, they're 65 years old and they simply haven't got a large enough corpus to retire on. That cycle is devastating, and you're absolutely right. All of us, whether we're in the media or we're in the financial services profession, we need to do what we can to inculcate the right savings habit in people, that buy high quality, well-run companies, invest in them through 10, 20 years of your working life. You'll retire with a handsome retirement pot. You'll retire with a hefty retirement pot.
Yeah, it may be boring, but that's what's typically works. Saurabh, it's great having you. Thanks so much for joining us today on this day when we hit new highs.
Thanks
great conversation. As also, thanks to the next guest who is joining in, Hiren Ved, Director and CEO of Alchemy Capital Management, joins us right now on the phone line. Hiren, so good of you to take time out and speak to us. Your thoughts, Hiren? This has come in at a time when a lot of question marks about how the economy is very sluggish, so on and so forth. But earnings growth necessarily not be at the mercy of economy, right?
Yeah. Hi. Good morning, Nilesh. I think, it's actually very difficult to correlate one-to-one, in terms of how GDP growth or the economy is doing in the stock market in the short to medium term, right? Because one of the dichotomies is that when the economy is not doing well, interest rates are low and liquidity is ample. And, we also have a context where global liquidity is ample and domestic liquidity is ample, and that is, typically driving markets. And if you go back in history for the last 30 years, you will see that every time we've had an extremely tough macroeconomic year, the subsequent year has been, a very good year for equity returns, right? If you look at 91, was a very tough year. 92 was great. I mean, if you look at 2008 was a tough year. 2009 was great for markets. 2013 was tough for the macroeconomy. 2014 was great. So I think if you look at it, I mean, if you take the 1 year period starting from when the IL&FS crisis hit us, which was August, September 2018, And then from there to August, September 2019 has been a very, very tough year just before the tax cuts. I think now, we've seen the kind of worst of the macroeconomy and growth, and the markets tend to look ahead, not behind. And I think the fact that the Nifty has hit a new high tells you that the economic recovery will happen over time, but the markets will tend to discount it well in advance.
Yeah, I think the markets typically tend to look at you right, and maybe the market always knows something that most people don't quite know. So let's leave this conversation about when the economy will recover. The question is, the markets have had new highs on the expectations of a few micro and a few macro events turning right. What's the big kicker for markets going ahead? Would it have to be earnings growth, or would normalcy in earnings and not necessarily blowout performance, but other factors falling in place work?
See, I think if you observe over the last couple of months, what I've been seeing is that each of the sectors that was stressed or not doing well is bottoming out in the stock market, right? I mean, you look at NBFCs, right? Most of the stocks are off their lows. You look at telecom, I mean, a very stressed sector, it's off its lows. Look at public sector banks. After the Supreme Court judgment on SR Steel, they are off, the bottom. Look at real estate; they are off the bottom. So I think what we are seeing is that one by one, many of the stress sectors of the economy are off their bottoms, and that's how typically a bottom formation happens. It doesn't happen overnight; it's a process. I think as far as the trigger is concerned, earnings, will come through. I think there is an expectation that the breadth of the economy will improve. But I think the immediate trigger is that many of the stress sectors, there is either policy initiative or there are factors that are falling into place, which is bottoming out each of these stress sectors. So I think there is a little bit of a mean reversion which will start to play out, where the broader markets will start to breathe some more life compared to the narrow movement that we have seen. And obviously, I think, the leaders of the pack will still continue to be, the high quality names. But simultaneously, you will see some kind of a bottom formation happening in the broader markets as well.
So, Hiren, good morning to you. And one last question on this conversation. What does 2020, according to you, look like? I mean, at the start of the year, you will have the budget, and expectations are with regards to some meaningful announcements in the budget as well. But does 2020 look like a year where, we've left the issues in the past, or do we carry the burden of sluggish growth with us in 2020?
I mean, my answer is twofold. I think from a stock market perspective, I expect 2020 to be a significantly better year than what we've seen in the past. As far as the economy is concerned, I think we should see a slow but a painful and slow, steady recovery in the economy, because the liquidity needs to percolate down to the broader economy, and that will take time. Right. But I think some of those conditions are in play, but it is going to be a very painful recovery. But as I said, let's not equate economic recovery to stock market performance. I think the stock market tends to discount the future. So if you're asking me how 2020 will be, I think for the markets, it will be phenomenal. For the economy, it will be a slow process of recovery.
Hiren, so good of you to take the time out and speak to us today. Thanks much. Really appreciate it. That's the view from Hiren Ved of Alchemy. And continuing with this conversation, because it's still steady, and now the Nifty Bank 2 intermediate on the intraday basis has hit fresh highs. Gautam Shah, founder and chief strategist at Goldilocks Premium Research, joins us on the show. Gautam, fantastic call. I saw your tweet yesterday when the markets were flattish, but you were confident that we will move ahead. Now the question is, that is done and dusted. What's next?
Morning, Neeraj. I think it's going to get better and better. I think after a long time, you have a scenario wherein markets are at highs, and there is just no euphoria, there is no real participation, and people continue to talk about the disconnect between the large caps and the mid caps. But I think I must make the point that the texture of this market is changing quite a bit. In the last 18 months, every time the Nifty went on to make a new high, it was the typical 4-5 stocks, that did well. But now when you look at an HDFC Bank or a Bajaj Finance or, stocks, which have done so well in the last 6-12 months, many of them have actually taken a back seat. So the argument which is in the marketplace right now, whether quality is going to take a back seat, that is actually happening. And some of the high beta names are now, are taking this market higher, which is great news. So the chart setup continues to look rock solid, even at 12,100. We have been working with a near-term target of 12,300. So I think we should get there in this current run. But eventually, I think over the next few months, we should see the Nifty moving towards a level of 13,000. So we recommend, an entry even at current levels. One needs to be a little sector specific, and many sectors, which underperformed in the last many months, like pharma and auto and oil and gas, have made a comeback. So I think with a strong base established around 11,700, 800, I think this market is headed much, much higher, and the global setup has got only better. So that's going to help Indian markets going forward.
All right. Gautam, let's talk levels, and let's talk, which pockets now are looking like, they're about to offer great trading opportunities to traders, if not investors, or maybe even a slightly longer term perspective. We're seeing cyclicals actually starting to turn around. Is that the new pocket of interest?
Well, it does look like, but then, you have to take a very stock specific kind of a call in that space. My favorites remain in the form of banking, oil and gas, and pharma. I think these are the three pockets that are moving with the market, showing a lot of relative strength. So for now, I think I would remain in these three sectors. And I think many stocks have built a strong foundation over many weeks and many months. And therefore, the manner in which the market is absorbing any negative news flow, I think that's a very positive sign. So I think the rally is broadening out, and cyclicals, as a basket will also do well.
Gautam, are you saying that the relative performance of the cyclicals might be better than the relative performance of, say, the blue chip names like HDFC Bank, HDFC, Bajaj Finance, Kotak Bank?
Yes, Neeraj, that's the view.
Okay. And then part two of my question is, therefore, would you reckon that the mid-cap end of the market, and these are loosely defined terms, but I'm just for the sake of argument, I'm saying the non-Nifty 100 names and quality names out there, or names which are looking at the charts, could actually give a better performance than some of the larger names too?
That's also the view, Neeraj. I think the Nifty Junior, or the next 50 as we call it, I think is a basket that looks very interesting at this point of time, because at least you have some fundamental backing there, and they are stocks that move greatly on momentum. On the mid-cap index itself, I think getting past 17,000 yesterday qualifies as a breakout which has been waiting to happen for almost 6 months now. And if this indeed is a breakout, which is my view, you could see the mid-cap index head towards a level of 18,500. So I'm talking of a 10% move on the mid-cap index in the next couple of months. And if that were to happen, I think Nifty might not do as well, because a 10% move on the Nifty is a little far-fetched. But I think the gap between the mid-caps and the small and the large caps, that's going to narrow over the next 4 to 6 weeks. So people's portfolio will start having the impact of returns. And I think that's something which market participants have been looking forward to for many months, even a couple of years now.
Gautam, while take your point in the mid-cap story, it can't be compared to what the index does. So when you talk about the index moving high, you can pinpoint and say, okay, these are 40% is financial. So if financial does well, index does well. Reliance Industries has a 10 to 11% weightage. So if Reliance does well, the index does well. The mid-cap is so diverse and dispersed in terms of the kind of stocks that it has. Do you feel that it's probably more prudent to pin it down to a few segments, or maybe even a few stocks?
Well, as I mentioned earlier, I think the Nifty next 50 is a segment I would strongly recommend your viewers to look at from a trading and investment perspective, because I think that's where the best momentum is. If you actually compare the Nifty next 50 with the Nifty or the mid-cap index, you will see that there is relative outperformance for many weeks and many months now. So that's a space I'm very, very convinced about. And if somebody wants to play the mid-cap story from here, I don't think it's late at all. I think if you look at the top 15 names which are being held by mutual funds, I think they are names, which have been quite rock solid in the last few weeks, and they are the ones that will do well. So one could easily, choose the top 5 mid-cap funds in the market and invest, and I'm pretty sure that over the next 1.5 years, you'll end up getting supernormal returns.
Okay, Gautam, appreciate you taking the time out today and look forward to hearing more from Goldilocks Research. Thanks so much for being with us today.
Thanks, Neeraj. Thanks.
Well, we take a break on the note that the indices are still steady at those high levels. For the Nifty, at least we're still at all-time highs. The Bank Nifty is just slipped a little bit after touching those levels, but nevertheless, still some traction there. So much market opinion, need to get in some corporate opinion as well. We take a break, Devina, and on the other side of the break, of course, get in the management of Blue Dart Express. Aneel Gambhir would be joining in to talk about how business is shaping up.